What happens if the US dollar collapses? A legal and economic primer on debt, inflation, and protection. 1. The hypothetical collapse scenario. Imagine waking up to the headline that the U.S. dollar has collapsed. What happens to your debt? Would it vanish or become easier to pay off? While tempting, the reality is more nuanced. A currency collapse would trigger massive uncertainty, widespread panic, and paralyze markets. Skyrocketing prices, financial turmoil, and evaporating savings would deepen public fear and destabilize the economy. Without knowledge of how such a collapse functions, one could find themselves at a catastrophic point of no return, unable to recover financially amid hyperinflation. 2. Inflation as a tool, blessing or curse? Inflation has historically benefited borrowers by eroding the real value of debt. If you borrowed $100,000 and inflation rises over a decade, that same $100,000 becomes easier to repay in devalued dollars. However, this mechanism is double-edged. Inflation also inflates prices and wages, making fixed-rate debt appear more manageable. But if hyperinflation occurs, the cost of basic needs may outpace wage growth, rendering this advantage moot. The key lies in balance. Moderate inflation may assist debt repayment, hyperinflation destroys economic stability. 3. A hypothetical case study in hyperinflation. Assume you buy a home with a $300,000 mortgage. The next day, hyperinflation hits. Your $4 coffee becomes $400, and home prices jump from $300,000 to $40 million. Your income, theoretically, would rise as well, perhaps to $10 million annually. At that level, paying off your mortgage becomes trivial. This example exaggerates reality to clarify the economic concept. If income and prices rise proportionally, pre-inflation debt becomes easier to pay off. Yet history shows that hyperinflation often causes massive unemployment and food shortages, undermining these theoretical benefits. 4. Defining currency collapse. A currency collapse occurs when a nation's currency rapidly loses value due to hyperinflation, economic instability, or loss of confidence. Historically, such collapses have been associated with excessive money printing, high public debt, and fiscal mismanagement. In nations with fixed exchange rates, collapses are exacerbated by government resistance to devaluation. When citizens and investors lose trust, they liquidate their holdings, leading to sharp currency devaluation and systemic collapse. 5. Global case studies: Zimbabwe, Venezuela, and Argentina. Zimbabwe, 2004 to 2009, saw inflation double daily as money was printed to fund war and compensate for failed agricultural reforms. Venezuela, 2013 to 2018, printed money to cover spending amid falling oil revenues, sending inflation to 65,000%. Argentina, 2019 to 2023, faced 50% inflation from policy missteps and debt. Each nation experienced social unrest, economic disintegration, and widespread poverty. These cases illustrate the real-world consequences of mismanaged currencies, and the limited value of debt devaluation in the face of humanitarian crisis. 6. Could it happen here? Despite its current global strength, the U.S. dollar is not immune to collapse. Excessive debt, continued deficit spending, and public distrust could erode its credibility. However, the dollar's role as the world's primary reserve currency provides substantial insulation. Global commodities like oil and gold are priced in dollars, sustaining artificial demand. But if that status were lost, through geopolitical shifts or international rejection of dollar-based trade, the collapse could be catalyzed rapidly. 7. Debunking the Saudi petrodollar myth. Recent media claimed a 50-year deal requiring Saudi Arabia to sell oil in dollars had ended. No such formal contract existed. Saudi oil has long been sold in multiple currencies. Moreover, the dollar's share in global transactions has risen, from 18% to nearly 33% in recent years. Though its use as a store of value is declining, global debt denominated in dollars sustains demand. Nonetheless, loss of reserve currency status remains a real, if distant, threat. 8. Debt dynamics during collapse. Debt becomes theoretically easier to repay in devalued currency, but practical barriers emerge. In hyperinflationary economies, unemployment soars and goods become scarce. In Zimbabwe and Venezuela, the population could not repay debt, not due to cost, but because they had no income. Inflation only benefits borrowers if wages rise in tandem with prices. Without this alignment, debt may become irrelevant, overshadowed by survival needs like food and medicine. 9. Credit in the collapse environment. Even in economic turmoil, credit reporting systems endure. Loan defaults during crisis can harm credit scores for years, limiting post-recovery access to financing. Thus, protecting creditworthiness remains vital. Additionally, inflation decimates savings and destabilizes markets. Investment portfolios may swing wildly, while cash loses purchasing power rapidly. Preserving financial resilience requires proactive preparation, not reactive desperation. 10. Preparing for collapse, strategic asset ownership. To withstand economic collapse, strategic diversification is key. Consider acquiring precious metals, gold/silver, foreign currency, yen, euro, Swiss franc, yuan, foreign stocks and bonds. Cryptocurrencies, e.g., Bitcoin, tangible collectibles, art, coins, firearms, income-producing real estate. Agricultural land and commodities. Off-grid survival tools, solar gear, food sources, barter goods, first aid, MREs, matches, water and energy-independent systems. Diversification across these assets helps hedge against dollar devaluation and systemic collapse. 11. The timing principle and final thoughts. Timing is critical. Waiting until the collapse begins is too late. Acquiring protective assets now positions individuals to weather disruption. Though most economists view U.S. dollar collapse as unlikely in the near term, it remains possible. Income-producing real estate offers stability in all conditions. Regardless of probability, preparedness is a prudent and lawful defense against economic uncertainty. Stay informed. Diversify. Prepare, not out of fear, but out of informed foresight. Knowledge remains the greatest currency in uncertain times.